The internet is full of financial advice. Some is good, some's pretty great, and some is downright dangerous. And after 17 years as a financial advisor, I've heard it all. So in this episode, I'm calling out the bad advice that still gets passed around today. And I'm going to show you how to avoid it so you can plan smarter, retire better, and keep more of your wealth in your pocket. Welcome, everybody, to another episode of the Planning for Retirement podcast, where we help individuals over 50 with at least 7 figures of assets maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to follow the podcast and also make sure to check out the YouTube channel where we put out weekly retirement-related content specifically designed for you, PFR Nation. Someone posted this social media meme that went viral, and I saw it this past week, and it really hit home with me. And it was basically saying, if you have kids, you don't really have 18 summers with them. You might have 12, maybe 13 summers, because once they hit that preteen or teenage years, it's no longer cool to hang out with mom and dad. And it really just hit home with me because summer's halfway over. And I've been fortunate enough where this year, now that we've moved into our new home, I've been working from home pretty much every day. I've not gone on into my physical office downtown since the end of school. And that's great. I mean, we've been busy unpacking, getting things situated, getting our house ready. But also, my wife just needs an extra hand. I mean, our boys are home. They have a couple of camps here and there. But for the most part, she is grinding with the kids day in and day out. And of course, I love hanging with my boys. So I'm available. I am free. And so I've been having this feeling of guilt because we work hard. Okay, don't get me wrong. I've been in this business now pushing 17 years. And I've been grinding in this industry. I love helping people plan for and execute a successful retirement. This is, I think about this probably too much, but I've been feeling a little guilty this summer because I'm like, I feel like I haven't been grinding as hard in my business than I had, let's say, before the school year ended. Then I saw that social media post and I was like, this really resonated with me because, our boys, we had them very close in age. They're 16 months apart. We've got our oldest son is about to be 6. And then our twins are 4.5. And so I feel like for us, it's going to go even faster because it's just all going to happen at once. Once it's no longer cool to hang out with mommy and daddy, it's probably not going to be cool to hang out with mommy and daddy for both sets, both our singleton as well as our twins. And I guess I bring this up because many of you probably don't have young kids anymore. You're probably already past the stage. Your kids are already out of the house. Maybe they're in college, or maybe they've already graduated from college. Maybe they're starting their own families. But I say this because as a grandparent listening, many of you are grandparents already. This also applies to grandparents as well. At some point, it's not going to be cool to hang out with grandma and grandpa any longer. And so enjoy those years. Enjoy that if you're fortunate enough to be near your grandchildren, enjoy those years because at some point in time, they're going to have their own life. And I see it personally with my oldest niece and nephew. They are 16 going on 17 this year. And I'm telling you, that's been happening for the last 4 or 5 years. So I think that social media post is spot on. And like I said, it resonated with me because I always have this feeling of guilt if I'm not being productive in whatever my definition of productive is for that day or for that particular week. And so I had that problem. I think many of you in PFR Nation also have that same issue too. I think that's why it's very difficult for many people to transition to retirement, especially the clients we serve. It's like they've been productive in their businesses, in their careers for decades. And all of a sudden they're transitioning to retirement. They're like, what does productive even mean? It's okay if you're spending time with your loved ones, spending time with your family, taking those trips, volunteering. Being productive doesn't just mean the next sales call or, writing a great white paper or making a presentation or building a business. It doesn't have to just be that. It can also mean other things as well. So I don't know. I just wanted to share that before we jump into this episode because it was something that impacted me. And I think it would resonate with a lot of you in PFR Nation, especially those of you who have maybe it's young children, but also maybe it's young grandchildren as well. Okay, so where this podcast idea came from, truthfully, it's just been something that I've been working on over time. I've been just creating a little list here of things that I just thought were not good ideas in terms of financial advice. And I've seen a lot of advice out there, especially with the internet now, with YouTube, podcasting, social media. There's a lot of people that are throwing out advice. And my experience in looking at this, a lot of these people have never actually helped people, individuals, with their own personal finances. And so that's why, as a skeptical individual with social media, I don't believe a lot of the things I read online just because I just know how these things work behind the scenes and who's pushing certain agendas. You've got to kind of follow the money, if you will. But anyways, I just see this advice that's pushed over and over again. And I'm kind of thinking in my mind, I'm like, this is done for clicks. This is done for engagement. This is done to generate interest or put eyeballs on a particular brand, whether it's a YouTube channel or social media presence or a podcast. And so I've just been taking note of this, and I've done some podcast episodes specifically designed for some of these things. So so some of the advice out there that I'm going to debunk today, I've done specific episodes dedicated to it. But we have a lot of new followers. We have a lot of new listeners. We have a lot of new subscribers on the YouTube channel. So I thought I would do a quick little short list of these 9 things, bad pieces of financial advice for mostly these retirees, the retiree, pre-retiree crowd that we serve, folks that are around the age of 60, they've got maybe a couple $1 million, but most of it's saved in pre-tax 401ks or IRAs. And so this episode is perfectly kind of in this sweet spot for you all that are listening to this podcast, Planning for Retirement podcast. So without further ado, why don't we jump into the list? And this is in no particular order. It's just there. So there are 9 things. And the first thing I want to throw out there is don't pay off your mortgage, invest the difference. Okay. Rick Edelman, who's one of the most well-known individuals in the financial planning space, Edelman Financial Engines. He's the owner and the founder of Edelman Financial Engines, built a multi-billion-dollar advisory firm, financial advisory firm. And this has been his advice for many, many years. Okay. And I'll actually pull a quote here from one of the papers that he wrote a few years ago. He said, never own your home outright. Instead, get a big 30-year mortgage, never pay it off regardless of your age and income. So right there, I'm just telling you, this is bad blanket statement advice. Okay. This is a perfect example of someone who's totally detached from working with individuals. Okay. But his advice is well known in the industry. His presence is well known in the industry. So publications, Financial Planning Magazine, Think Advisor, all these publications are going to take that quote and put it into their content, because if you see the name Rick Edelman, you're going to click on it. Okay. But he's totally detached at this point. He hasn't worked with an individual client in multiple decades. And I bring this up because he's pushing his own agenda. He wants to build his investment advisory business, investment advisory firm. How does he do that? Gathering investment assets so they can charge, I think 2% a year is what they charge their clients. Maybe it's 1.5 or 2% a year. Okay. And I'm not attacking the fees. I think that's a little high personally, especially for the clients that we serve that have about $2 million. You should probably be paying under 1% of your assets. But I digress. His agenda is gathering assets. So if you're paying off your mortgage, that's less than assets that they have available to manage within their firm. Okay. And I see this advice get pushed not only with Edelman, I'm not just calling out Edelman, but other financial advisory firms too. And I'm telling you, having worked with retirees, that it made sense on paper for them to just not pay off their mortgage. Maybe their interest rate was 3.5% or 4%. We still recommended they pay down their mortgage because it gave them that sense of security that they had no debt on their balance sheet. And that was one of their goals for, let's say, 20, 25 years, 30 years, maybe 30 years since they took out that mortgage on their home. And maybe they lived in that home for 30 years and then now it's paid off or it's close to being paid off. The sense of accomplishment there, you can't put a price tag on that. And so, yes, mathematically, it could make some sense, especially with those lower interest rates, 3.5%, 4%, to say, hey, you know what? We can invest in a pretty well-diversified portfolio and we probably could get a higher rate of return on some kind of side fund as opposed to what your mortgage interest rate is. But that's no guarantee. And also now that interest rates have come up, I looked at the 30-year mortgage rate yesterday. It's hovering about 6.75%. If you look at a 30-year treasury bond, we're at in the 4% range. So now it actually probably does make more sense for you to pay down your mortgage a little bit more aggressively than you would have, let's say, from 2011 to 2023, we'll call it, before rates started to come up. So I see this advice pushed oftentimes, and frankly, it's oftentimes pushed by financial professionals who have the agenda of just gathering your assets and putting them under their management as opposed to doing smart planning. And I say this as an advisor who manages assets for clients in retirement. I am telling you that I like the idea of having maybe little to no debt in retirement because it gives you that peace of mind. you can have a little bit more flexibility with your spending because more of your spending is discretionary as opposed to fixed spending, right? So again, it's never one size fits all. And some of you listening may think, you know what, Kevin, I have a 4% mortgage. I'm totally comfortable not paying that down and having a side fund because I can earn 5, 6, 7%. To each their own. Financial planning decisions should personalize. And I'm bringing this as number one, just because I see this as blanket advice across the board. And oftentimes I see retirees and pre-retirees kind of get tricked into this where they're like, hey, I'm not going to pay down my mortgage aggressively, or I'm going to take out a big mortgage and I'm going to keep that side fund intact. It's not always in your best interest to do so. So you need to not only look at the quantitative factors, but also the qualitative factors as well. Okay, number 2 is around Social Security. And this could go in so many different directions. But I feel like when I first got in the industry, let's say 2008 to 2015, the advice was actually taking Social Security a little earlier. Okay, so maybe at full retirement age or at 62, because you don't know how long it's going to be around. And so take Social Security now because you never know if they're going to change the rules, or that way you don't invade your portfolio in those early years during that bridge period is what I like to call it. But I've seen now the common advice that's being pushed is delay Social Security until 70. Okay. And, I guess I'll put that as the number 2 is the advice I've seen is always delay Social Security until 70. And I'm just telling you that sometimes that could make some sense, especially if longevity is on your side, if you have the assets during that bridge period, the bridge period being when you retire up until you start collecting Social Security. So maybe you have a bridge of only 3 or 4 years, so maybe you retire at 65 and your plan is to delay until 70. So maybe you have a 5-year bridge, and maybe you have sufficient assets where you can sustain a little bit of a higher rate of withdrawal during that early period. But maybe you don't, maybe you retired a little bit earlier. Maybe it's at 62. You're forced into retirement. And maybe you have a nice little nest egg, but you don't have enough to bridge the gap completely until 70 without making you feel extremely uncomfortable with depleting your portfolio, especially if you go through some periods of volatility. What if you retire in a year like the 2008, 2009, or the beginning of 2020, at the beginning of the pandemic, or even 2022 during the triple bear market where stocks, bonds, and cash were in a bear market. So you don't know what the future holds. And so I think having a fluid discussion around Social Security claiming, like having a game plan, and even if your game plan is to delay until 70 because longevity is on your side, that could potentially change. What if you get a diagnosis or your spouse gets a diagnosis, which completely change your longevity? Or what if the market totally reverses course and you don't have a really strong performance during that bridge period? That could result in you really significantly depleting those portfolio assets. Yes, you need to weigh the longevity factor. If you do delay until 70, you should expect, no one has a crystal ball in this one, but you should expect to at least live until 80, 82, depending on your Social Security benefits. But, thinking it through spousal benefits is also relevant there too. But I think not only looking at the longevity factor, but also where are you going to tap into your portfolio from? How are you going to bridge that gap? And making sure you have a game plan, plan A, but also plan B if things don't work out as you initially had anticipated. So I guess the Social Security advice is there's no one size fits all. Okay. And claiming the perfect Social Security decision involves in knowing exactly how long you're going to live. No one has that crystal ball. And so, I think being comfortable with your decision, but also understanding that you can pivot even in retirement. Just because you started Social Security early, you can pivot. Or if you plan to delay, you can pivot and take it a little bit earlier. So there's no one size fits all there. And I think aligning the Social Security decisions with your personal goals, your personal risk tolerance, and also what gives you the most peace of mind is what I would recommend all of you do. So not only weighing the numbers, but also weighing that qualitative factor of what's going to allow you to sleep really, really well during retirement. So number 3 doesn't really come up as much with the retiree crowd, but it certainly comes up with the pre-retiree crowd. If you're in that accumulation phase, let's say you're in your 50s and, you have a high income, you may have heard the push for permanent life insurance as a savings vehicle. Okay. And I come at this with an interesting perspective because in the first 6 years of my career, I worked at one of the big insurance companies. So we did financial planning, but we predominantly sold insurance. And so I kind of saw firsthand, I saw firsthand how this advice worked, where it was lead with the financial planning process, which was a great process. I really liked the financial planning process at the beginning. But then you deliver the plan and your recommendations always included, for the most part, some kind of allocation towards buying permanent life insurance. And this is typically geared to those high income individuals, maxing out 401ks, maxing out backdoor Roth accounts, maxing out the HSAs. And then they still have some money left over. And a lot of you listening are probably in this scenario. And so I would say is that may or may not make sense. And I did a whole episode on whether or not it makes sense for you to own permanent life insurance in retirement, but it's less on the factor of the savings tool, the cash value piece, and more leaning towards having or wanting a permanent death benefit throughout your retirement. And those are two different things. And when you're buying life insurance, you're paying for life insurance. And so using it as a savings vehicle, if you don't need or want permanent life insurance, the death benefit in retirement, why are you paying for life insurance? There are other vehicles that are still tax advantageous that you can utilize in retirement in lieu of permanent life insurance. And this also may come up with your children, your adult children. You know, a lot of you that are successful, you've successfully raised your children and maybe now they're successful in their own right. Maybe their income is higher than yours at this point in time. And maybe they're in their 30s or 40s and they're earning a higher income than you ever had in your working years. And they're getting the pitch. Okay. I think this is also advice for them too, is really be cautious of that. And I'm not saying permanent life insurance is a bad tool. I personally have kept my permanent life insurance policy and I plan to keep that for my entire life. I like that as an idea of an alternative cash bucket, but I also like the idea of having some kind of death benefit when I pass on, whether it's in 5 years, 10 years, or 40, 50 years down the road. And so I want to have that permanent death benefit in place as a legacy floor to the next generation. That way, my wife and I, we can really spend time enjoying retirement, not having to worry about preserving our assets to leave to our kids. Of course, we'd love to do that, and we plan to do that during our retirement years. However, I think the permanent life insurance discussion is definitely, the savings aspect of it is definitely overinflated. And yet you really need to be careful with that and cautious, because ultimately you need to follow the money. It's ultimately being pushed by advisors whose compensation is largely contingent and dependent on selling permanent life insurance to you, whether or not you need it or you don't. All right, number 4 I'll throw in there is you don't need a Roth account because you're going to be in a lower tax bracket in retirement. So maybe you have a couple of million in pre-tax accounts, okay? And maybe you're focusing on those traditional IRAs, traditional 401ks or 403bs or TSPs, whatever your flavor is. And you may have heard, hey, you know what? In retirement, you're not going to need a Roth because once you start withdrawing, then you're going to be in a lower tax bracket, which if you've been following our YouTube, if you've been following our podcast for a while, I don't disagree with that. I actually think many of you who are in that high earning phase of life, late 50s, early 60s, you're in your peak earning years, it probably makes sense for you to do the majority, if not all, of your savings contributions pre-tax and not do Roth contributions. However, there is a window of time upon retirement until you start collecting Social Security, until you start taking required minimum distributions, which for most of you will be either 73 or 75, where you will be in a lower tax bracket. But that does not last forever. Once you start taking Social Security, that is counted as income. Once you start taking required minimum distributions, that will be income as well, whether or not you need all of those RMDs or not. And so I call this period of time the Roth conversion window. And you need to really evaluate whether or not it makes sense and if it's aligned with your long-term plan to do Roth conversions, because if it does, you need to take advantage of that Roth conversion window. So maybe, yes, pre-retirement, while you're in those high earning years, you're going to want to focus on pre-tax. But the fact that you would ignore Roth accounts simply because in retirement, you're going to be in a lower tax bracket, that's when you actually want to get aggressive with taking distributions from those IRAs and potentially converting them to Roth. Again, if it makes sense in your long-term plan. It's not for everybody. You need to crunch the numbers in all aspects, not only in your lifetime tax bill, but also potentially your heirs tax bill. There are so many factors that go into Roth conversions. But if it aligns, if it makes sense in your plan, and if you want to do Roth conversions, that's when you want to get aggressive with those Roth conversions, is in that Roth conversion window. All right, number 5 is keeping things in cash or market timing. And I see this time and time again. Dalbar famously did a study on investor behavior, and they track returns by investors, retail investors, and compare those returns to the actual funds that those investors owned. And they typically have found that there's a lag. Now, I am a little skeptical of the data here. Where are they getting the returns? Like in terms of the equity returns from those retail investors, how do they actually track that? What about timing of rebalancing? What about moving out of a particular fund and swapping it for another fund within the portfolio? So I'm a little skeptical of the actual data, but I do see behavior come into play. And this is kind of going along the lines of the Warren Buffett quote that I love to throw out there, which is be fearful when others are greedy and greedy when others are fearful. And really where this comes from is when people are chasing fads. If you kind of think back to the late 90s with the tech bubble bursting, people were chasing the dot-com stocks. Anything that ended in .com, they were buying it. And it didn't matter what the fundamentals were. It didn't matter if they had ever even heard of the company. They were just buying these .com stocks. And that led to the .com bubble crashing in 2000 to 2003. Real estate, same thing, led to a crash in 2008, subprime mortgage crisis. You think back to crypto. Crypto, same thing. Bitcoin was kind of the leader there. And then you had all these other altcoins that people were chasing, Dogecoin, Ethereum, all these other things. I'm not saying you shouldn't evaluate crypto as part of your allocation. I did a whole podcast episode on crypto and whether or not it makes sense for investors to own Bitcoin. We have some of our clients that own Bitcoin ETFs in their portfolio because they understand it and they believe in it as part of their long-term risk allocation. I personally have some crypto in my portfolio as well. But I think chasing fads. And right now, the fad that we currently have is this idea of chasing AI, artificial intelligence, which I'm a fan of. I am not anti-AI. I'm actually pro-AI. And I do believe it can add some efficiencies to the work that we're doing and complement the work that we're doing. I don't believe it's going to replace people. I think people are still the kind of the core of what is going to actually maximize the use of AI. Without people, AI is useless, in my opinion. For most things. Now, there are certain things that you could say, you know what, AI can completely replace it. Sure. Curating research, curating information, very difficult for a human to actually replace that. However, you need to take that research and take that information as a human, analyze it and apply it to your trade. So I think this idea of flocking to something, this fear of missing out is a big thing with investors and a big thing with the 24/7 news cycle, with social media, that I think is actually getting worse. I think people are now chasing fads more today than has ever been since I've been in the industry and since I've been watching investors and being in personal finance over the last 16, 17 years. It's worse now today than it's ever been. And this idea of fear of missing out is absolutely getting in the way of long-term fundamental investment strategies that work, as opposed to trying to chase the latest trend or trying to chase the latest fad. Or on the flip side, when fear is driving the markets, moving out of a well-diversified, thought-out investment strategy just because you're afraid of what may happen with an election or what you think may happen with inflation or what you think may happen with interest rates. No one can predict the future. No one can predict how the markets are going to react to news. And Deliberation Day is a perfect example of that, where we had the markets crash after April 2nd this year, but then have fully rallied back to their previous highs and some. And a lot of investors, I know for a fact, I've observed them. We have none in our client book, thankfully. But after Liberation Day, after the market crashed 20%, they moved to cash and they were waiting it out because they thought the markets were going to continue to go backwards. I've seen this time and time again practicing in the financial planning space. And I see this as a big mistake investors make. You PFR Nation who listen, I'm a big believer in this idea of a disciplined, unemotional, repeatable process, DERP. And if you have a disciplined, unemotional, repeatable process, it's very difficult to make big mistakes with your investment strategy. And that expected rate of return is going to make or break your long-term financial plan. If you make a big mistake, that could cost you years of retirement income or potentially a substantial legacy, or potentially being able to self-fund your long-term care, being able to maintain your dignity at the end of your retirement. And so this is one of the biggest things that we deploy or we help our clients with, is coming up with what is the right investment allocation? What is the right allocation to US stocks versus international stocks versus small caps versus fixed income versus international bonds, and help them create that allocation, and then staying disciplined through the ups and downs of the markets when it's very easy to want to chase trends. Don't do that. Okay, number 6 I put in here is just self-fund long-term care. Insurance is a ripoff. And I understand where this comes from. I think there's a deep sense of distrust in the insurance industry. Consumers don't trust insurance companies. I'm probably one of those individuals, but there are some good ones out there. There are some good companies out there that have delivered on the promises that they've made to their policyholders. And I oftentimes see this as blanket advice, typically from financial professionals, especially the ones that are anti-insurance, that don't sell insurance in the fee-only space. And by the way, I am one of those advisors. We are a fee-only registered investment advisor. We don't sell any insurance products. But I've personally witnessed how long-term care insurance can actually benefit a couple that are in retirement, planning for retirement and in their retirement phase, and particularly on the surviving spouse. Because oftentimes, let's say it's a married couple, let's say it's male and female, the female has a higher likelihood of outliving the male. And so at the end of the male's life, if they need some care, obviously they're going to need to figure out a game plan. Will they, and if they don't have insurance, by the way, what is the game plan? Are they going to pay for care? Or is the spouse going to step in? Is the wife going to step in and provide that care for her husband? Or a combination of the two? Typically what I've seen is that if there's no insurance, even if the surviving spouse has adequate assets to self-fund that care, they typically will just step in and do the care themselves. And oftentimes this results in physical, mental exhaustion during that caregiving phase. Sometimes it could be 6 months. Sometimes it could be a year. Sometimes it could be multiple years. And the longer that goes on, the more the surviving spouse is going to be totally drained at the end of that event when that husband passes away. And this is the argument to have insurance because again, regardless of the size of the investment portfolio, there's always this concern from that caregiving spouse, like, hey, I don't want to spend too much money on care because I still may live another 10, 15, 20 years. There's always that uncertainty there. So that's why having insurance, a dedicated pool of funds to pay for that care, is oftentimes a good idea. I'm not saying go out and buy a huge policy that would fully fund memory care for 10 years. I'm not saying that. But maybe you have some kind of pool of funds that you can pull from to give you a little bit of break, to kind of force you to spend the money on care, whereas otherwise you may not have spent the money on care. And so again, I'm not saying insurance in all cases. I'm not saying self-fund in all cases, but having that conversation is a big part. And if you go the route of self-funding, just making sure some dialogue is had for that potentially caregiving spouse, or maybe it's caregiving children. Maybe it's your adult children. Maybe you're not married, but you have adult children that potentially would need to step in if you needed care. Do they have a game plan in terms of where they're pulling the assets from? So I think this idea of self-funding for long-term care as a default recommendation is typically harmful. But I will say, if you go the insurance route, make sure you're dealing with a trusted partner, someone who's looking out for your best interest, someone who doesn't just sell insurance for one particular company, that they can evaluate the market, because the insurance market is constantly evolving. It has changed dramatically. Since I sold insurance back in 2008, it has changed dramatically, the long-term care space. So deal with a trusted professional that is objective and that is not going to push a particular product or company just because that's where their paycheck is coming from. Number 7 is what I would say is annuities are all bad, right? Or on the flip side, annuities are the be all end all. This is kind of the two extremes that I see in this space, is bad advice on annuities. And typically the advice coming from fee only advisors is annuities are all bad, just invest your money so it's liquid, versus advisors that are selling insurance products and in particular annuities, all they do is hawk annuities, sell annuities. And I just think this is doing the product a disservice. What are annuities for? Who are they benefiting? What are you trying to solve for? And typically what an annuity should be purchased for is to solve for some kind of guaranteed income that can never be outlived, kind of like a pension. You know, if you have a pension with your employer, you're going to be able to turn that into a paycheck at retirement that hopefully is going to supplement Social Security for many, many years to come. That provides some sense of security, some peace of mind that is impossible to replicate in the markets. You know, you cannot replicate a guaranteed income stream in the markets compared to an annuity. So this is where the annuity fits in. But then how much do you have inside of an annuity, right? If you have no pension and your Social Security represents a very small percentage of your income needs, maybe it makes sense to have some annuity some kind of baseline to take care of your fixed expenses. On the other hand, maybe you have a large pension and Social Security incomes, and maybe that covers 70 to 80% of your total income or cash flow needs. Maybe it doesn't make sense for you to have any annuity income because you can supplement that income stream or those income streams with your investment portfolio. So it's never a one size fits all, but I typically see advice on either extreme. Annuities are bad or annuities are going to solve all of your problems. The Swiss Army knife of financial products. Be wary of that and make sure you're working with a trusted professional who's objective to the product. All right, number 8 is follow the 4% rule and you're going to be fine. I think this is just overly simplistic. It ignores taxes. It ignores sequence of return risk. It ignores personalized income and cash flow needs. And it also ignores timing of cash flows. This totally ignores things like Social Security income or pension income, right? Or the go-go years versus the slow-go years or no-go years. And Bill Bengen, the father of the 4% rule, genius, by the way, acknowledged this. This was not meant to be followed as the be-all, end-all. It's meant to be a benchmark. And so that's what we like to use it for, as a back-of-the-napkin benchmark. Take out the napkin, take out your portfolio. What's your portfolio value if it's $2 million? How much income do you need to withdraw from your portfolio? Maybe that's $100,000 from that $2 million. That's a 5% rate of withdrawal. Let's compare that to the 4%. Not too far off, maybe a little bit aggressive, okay, but not too far off. And in many scenarios, with the 4% rule back testing, you've actually, at the end of your life, your portfolio actually increased sizably. Okay, there were a couple of scenarios where your portfolio actually was depleted if you started with a 5% rate of withdrawal, but that's where I like guardrails coming into play. If the markets are performing negatively relative to what you're expected, maybe you have some sort of guardrail rule where you could potentially back down your withdrawal rate given the market circumstances. But on the flip side, if the markets are behaving and doing well, you can also increase your spending during those periods of time. So I think the key is to be able to be flexible and also be able to be willing and able to cut certain expenses if that happened. And I think that's where the kind of the needs, the wants, the wishes, breaking those down in terms of your budgets and cash flows, and then sort of comparing that to how much of your income sources are guaranteed and how much of that is covering your needs versus your wants and wishes. And I think this could also play into that annuity discussion and also the discussion on paying down your mortgage. Or number 9 is convert all of your IRA to Roth. Ed Slott, very famous CPA in the financial space. I also believe he's a genius, very smart guy, very smart business guy. But he's probably the loudest in this camp where he's basically citing higher tax brackets in the future, comparing the current tax brackets to what they were back in the 60s and 70s, citing the Tax Cuts and Jobs Act likely sunsetting at the end of 2025 or government waste, all as reasons to convert all of your IRA to Roth. And this may make sense for some people, but I've actually, in most cases, I've actually seen scenarios where it does make sense to keep some of those assets in traditional IRAs. Maybe you're charitably inclined. So qualified charitable distributions can come into play. Maybe you're converting to a higher tax bracket than your kids will ever be in. Maybe you have some healthcare costs at the end of your life that you could potentially use as deductions to offset those taxable IRA distributions. Or maybe you're planning to leave your IRA to charity. In that case, why would you convert to Roth? So there are reasons to not do conversions. And then there are certainly reasons to not convert all of your IRA to Roth. I like the idea of some tax diversification, having a nice equal blend between taxable accounts, tax deferred and tax free. And if you do have, let's say the majority, if not all of your assets in tax deferred, maybe it makes sense for you to do some Roth conversions during that Roth conversion window, but then slow it down once you start Social Security or require minimum distributions. So I don't think this should be an all or nothing thing in terms of Roth conversions. So we already talked about before, not converting anything. This would be the other extreme, converting all. And I typically find there is reason to be sort of in the middle and have a blend of those two strategies and those two philosophies. So that's the list. I hope you guys found it helpful. I'd love to hear from you. I'd love to hear in the comments, what are some bad pieces of advice that you've received or that you've seen someone implement in their financial situation that you want to share with PFR Nation? Drop a comment. You can do it right in the Spotify episode. You can also do it in YouTube as well. But would love to hear from all of you on what you thought of the 9 things that we put in as bad pieces of financial advice. And again, thank you all for listening to the episode. Make sure to follow along the podcast and obviously subscribe to the YouTube. We put out some really good YouTube videos over the last couple of weeks related to the One Big Beautiful Bill Act, did some case study scenarios on the potential impact in 2025 and going forward on the One Big Beautiful Bill Act on retirees. I think there's a lot of things to look at. There's still a lot of moving pieces in terms of, okay, how are we going to actually deploy this with our clients at the end of 2025 and beyond? We're really, really looking forward to all of our reviews for all of our clients. If you're listening and you're a client, in the fall, we do our tax planning review. So Roberto and I, we're going to be crunching the numbers in Holistic Plan, running those tax projections for all of you to see how you were impacted personally and some of those planning opportunities that might benefit you. And if you are listening to this and if you're not a client, make sure to consult with your own financial planners, your own financial advisors before making any moves and figure out, hey, what is the impact with these tax policies on your financial situation? And if you're interested in getting a second look or a second set of eyes on how we work with clients, we typically serve folks that are approaching 60 that have about $2 million in investable assets. Most of them are in tax deferred accounts or IRAs, 401ks, and they want to maximize their retirement spending, but they also want to minimize their lifetime tax bill, and they just want to worry less about the financial markets. If that is describing you, make sure to check out our website, www.imaginefinancialsecurity.com, or you can start with the retirement readiness questionnaire that is linked in the description of all of the show notes. We'd love to hear from you. We'd love to work with our listeners. And we'd love to learn more about how we can help you plan for and execute a successful retirement. Thank you all for tuning in. Until next week, this is Kevin Lau signing off.